Hi everyone, welcome to this CIMA webinar for the BA3 certificate exam. Before we get any further, before we get going, I'd just like to clarify that we do have a question and answer box open for this webinar. So if you do have any questions that you want to ask in the duration of the presentation, please do use this facility, okay? So with that out of the way, let's get going with the first of the three areas that we are going to be dealing with in this webinar, okay? So this is, of course, as you can see on your screen at the moment, the bookkeeping process. And I've decided to tackle this issue in the webinar today, as I do feel it is a fairly sort of fundamental, fairly important aspect of the BA3 syllabus that sort of should underpin all your knowledge about this when it comes to the exam, okay? So I've got the process set out on I've got the process set out on screen in front of us, and we can see quite clearly that this starts with the initial recording of transactions and stems all the way through to the final financial statements that a business produces, okay? And as part of this, we have several steps that we need to be familiar with for this exam, okay? So we have the recording of transactions in Daybooks. We have the transfer of these transactions to the nominal ledgers. We've got our sales and purchase ledgers, which we can see to operate slightly outside of this process. And then we've got a reconciliation between these ledgers and our nominal ledgers, okay? So it's going to be these four middle steps that I'm going to focus on purely from a time perspective in this video today. Okay, so our daybooks. Now, you may see that these are also referred to as books of prime entry or journals, essentially. So whenever you see these three pieces of terminology, essentially you are referring to the first place that transactions will ever be recorded by a business, okay? Now, a business may record hundreds or thousands of transactions every day. These need to be recorded initially in some location. So it is these daybooks where these are recorded. Now, you will see these split up into specific groups. So, for example, we have a specific cash daybook, a specific cash journal, and we also then have specific books in relation to credit transactions. So credit purchases will be in one daybook, credit sales will be in a separate daybook. And we will also see different daybooks for things like returns in and outwards, okay? And then at the end of a set period of time, maybe at the end of a month, for example, maybe at the end of the accounting year, daybooks will be totaled, and these will be entered into the nominal ledger as we saw earlier on in the process, okay? So what we have on screen is three transactions, and all we're going to do is just show you how these would be entered into the relevant daybook, okay? So obviously we are dealing with the sale of goods here, with sale of goods on credit for the purpose of this transaction. And so we are going to record all of these transactions in a sales daybook, okay? So this will record all of these sales on credit that this business is engaged in within this specific period, okay? So you can see that we're working to August here. And we can see that at the top of this sort of daybook, we have a number of specific bits of information. So each transaction will have a date when it's occurred. It will have a unique reference number in terms of the transaction itself. It will have details about the person, the party that this transaction is involved in relation to. And also we will have a number of bits of information about the value of the transaction, any tax associated with it, which you can see is accounted for separately. And finally, the total of this transaction, okay? So nice and simply, we would account for these three transactions when they have occurred initially in the sales daybook as so. So nothing really too difficult here. Simply recording the date of the transaction. We have a unique document number to represent this sale to this company LM. And then we can see that the value of the transaction and the sales tax attached to it are split before a total is included, okay? And we can then see that we have a total for all the transactions in this daybook in this period. So after transactions have been recorded in the daybook, we can move on to the next stage of our bookkeeping process, which relates to the sales and purchase ledgers. Now, as we sort of saw, these operate outside the bookkeeping process in and of itself, and these are for accounting for credit transactions only, okay? So a crucial piece of information to remember. And essentially, these ledger accounts show individual information for each customer or each company that a business is engaged in, okay? So crucially, we do not subject these ledgers to double entry. Okay, so double entry bookkeeping is probably something you're getting familiar with over the course of your BA3 study so far. This is one of the areas that is exempt from this type of accounting. Okay, so we only make one entry per transaction in these ledger accounts. So let's bring up the three transactions that we just saw in the relation to our previous example, and let's show how we would account for these in our sales ledger. So how would we account for these? What side of the ledger would we need to put these on? Well, it's important to remember here that the sales ledger essentially acts in the same way, it functions in the same way to the receivables account that is used to account for credit transactions that we'll come across in a little bit later, okay? So essentially what we are recording here is credit amounts that a business is owed. So these are asset accounts. And therefore, we make a debit entry to record these sales, okay? So increasing the asset essentially, i.e. the amount of money that a business is owed from various parties. So starting with our transaction from LM, we can see that this totals £600 with a little bit of tax involved. And we simply make a debit entry in the sales ledger accounts to show that essentially business LM owes the example company here £600 following a sale on credit. And then we can repeat this process for NO and also for TU. So another debit entry for NO to show the £120 that this company owes as a result of a credit transaction. And again, we repeat the process for TU. If LM were then to go and settle this transaction, we would see a corresponding credit entry be made here for £600. And this would essentially reduce the amount in LM's individual account within this company's sales ledger that it owes to this business, okay? So in this way, we can really closely keep track of the amounts that specific parties owe to us as a business, okay? The third stage of our process relates to our nominal ledger, okay? So transactions, after they've been recorded in Daybooks, need to be added into the nominal ledger. Now, this ledger, unlike our sales and purchase ledger, works on a system of double entries, and therefore both aspects of these transactions that are involved here need to be recorded. The other thing that we need to keep in mind is that we don't record individual entries from Daybooks, okay? So as we saw when we looked at the Daybooks earlier in the process, we total the amounts within individual Daybooks up, and it is these totals that we include as part of our nominal ledger. Remember, if businesses are involved in hundreds or thousands of transactions every single day, for example, for large businesses, then this is going to be a huge amount of transactions to account for. The nominal ledger would be no use to anyone, if we included everything in here. Okay, so as a result, we include this summary that we have at the bottom of our sales daybook. So how do we go about translating this amount that we have in our sales daybook into our nominal ledger? Well, essentially here we need to employ a bit of our knowledge about double entries. So what we are looking for here is a sale on credit. How do we go about accounting for this? Well, on the one hand, we are going to have to account for an asset, i.e. the receivable stemming from this transaction, which is the result of this business essentially being owed money as a result of the various purchases from these parties, okay? So we make a debit into our receivables account. So we show the 750 in relation to sales, and we also include our taxation total in there. The other side of our double entry is then, of course, income, okay? So the business is obviously going to generate cash eventually from this transaction, but we also need to record income in our statement of profit or loss. And so we record this income in our sales income account with a credit entry, which of course increases income, okay? Now notice that we are only accounting for the 750. That is the value of this transaction. We're not accounting for the tax in this income account. And this makes sense, okay? So the business is owed the full £900 as a result of these sales from consumers, but it is only entitled to this £750 worth of income from the sale, okay? So the remaining £150 worth of tax can't be classed as income. It's going to be tax. It's probably going to go to the taxation authorities. And so we account for this separately in a tax account, which is a liability account. So we credit this account to increase our tax liability by £150. Finally, the last step of the process that we can deal with in this question relates to the reconciliation of these two accounts. Now, the reconciliation of our purchase and sales ledgers with the relevant accounts in the nominal ledger is essentially a method by which businesses can ensure that their transactions are correctly recorded, okay? So what we're going to do is we're going to bring up our sales ledger. As we can see that this totals £900 at the bottom of the screen here. And then we're going to reconcile this. We're going to compare this with the totals that we brought up in our receivables balance. And as you can see at the bottom of the screen, the amount in our sales ledger should equal the total of our receivables balance. And quite clearly, I know we're dealing with a simple example, but the principle is demonstrated really clearly here that we have the same total in our receivables account. And this therefore provides us with a level of reassurance that transactions have been recorded correctly and that we have no errors in this example, okay? Now, there are further steps of this bookkeeping process. However, we don't have time to address them in this particular webinar. So if you do want to learn a little bit more about them, there are plenty of resources out there to help you with this. So what we're going to do now is I'm going to flick over to a question. And I'm going to run through a sort of sample exam question for us to show how we would deal with this in the actual exam, okay? So we can see in our question that we have a company E, that makes a number of sales in the month of April 20x9. And then we are asked in this question, assuming sales tax is already included in these transaction amounts, so we don't have to account for sales tax here, calculate the balance of company E's receivable account in its nominal ledger at the end of April. So first things first, what stage of the process are we dealing with here? Well, obviously, we are dealing with this part of the diagram here. Okay, so these individual transactions within April would already have been accounted for in our daybooks. And then essentially what we have done here, or what we will be doing here, is totaling up these transactions and including them in our nominal ledger. Okay, so whenever you deal with a question on this topic, it's really important that you sort of familiarize yourself, you orientate yourself almost with the area of the bookkeeping process that you are dealing with. So I know we said that the transactions are already recorded in the daybook, but for the purposes of answering this question, I think the easiest thing for us to do would be to generate a mock account, a mock receivables account for our nominal ledger, and to enter these transactions one by one to show how they would be built up in this account and therefore to calculate our total account balance, okay? Which is of course the objective of this question. So we're going to run through each of the transactions you can see on screen one by one and decide how we would account for them. So on the 1st of April 20x9, customer B purchases goods worth £1,900 from company E on credit. Okay, so we have our first credit transaction to record in the receivables accounts. What are the double entries associated with this? Well, obviously, we are going to debit receivable, as we saw in the presentation earlier, and we are then going to credit our sales income, okay? So in our receivables account for the 1st of April, we are going to have a debit entry of £1,900 in respect of this transaction from customer B. We can then repeat this process for bullet point number 2. So in this transaction on the 4th of April, X9, customer N made a credit purchase from company E of 2.5k on credit yet again. So exactly the same double entries for our second transaction. And if we return to our mock receivables account, we can enter this transaction in exactly the same way in this account. Okay, so we are going to make a debit entry of £2,500 in the receivables account. Transaction number 3 on the 9th of April is a £450 purchase by company O. Crucially here, this purchase is made in cash. So remember, the receivables account only deals with credit transactions. So this is one of the little areas you'd need to watch out for in the exam, potential way the examiner could trip you up. You, of course, don't want to include cash transactions in your receivables account. Instead, we would account for these by debiting the bank account and then crediting our sales to recognize the income from these. So for the purpose of this question, the transaction with customer O is completely redundant and we can ignore it. Transaction number 4 is another purchase on credit, this time of £6,000 by company P. So once again, we can repeat the process. We can add this third transaction in. So we can debit receivables with this £6,000 amount. Transaction 4, customer O returns their entire purchase. So how do we account for this return? Well, hopefully, thinking back to bullet point 3 up here, you'll realize that actually this is another piece of redundant information in the question. Again, we are dealing with a cash transaction here, and so we don't need to account for this in this question with the receivables account. Finally, our last bullet point states that customer B settles their entire £1,900 purchase, okay? So remember that receivables show the amount of money that a company is owed as a result of credit transactions. So if a customer settles their transaction, then we need to cancel out this receivables balance. We need to cancel out this asset as we no longer have this outstanding credit transaction. Okay, so we would credit receivables and we would debit the bank account to recognize the customer, actually settling this transaction. Okay. So in our receivables, we would add on the 28th of the 4th, this settling transaction. Okay, so 1,900. We're now in a place to total up this account and to find our balancing figure. Okay, so to do this, we need to total up all the debit entries that we have. We need to total up the credit entries and we need to find the difference. Okay. So the total of all of these credit entries stemming from credit sales is £10,400. And obviously there is a difference between this and the sole credit entry of 1,900 we have recognized in the bank account. Okay, so we need the difference between these two figures. And this will be our balancing figure. Okay. So 10,400 minus 1,900 gives us a final balancing figure for this transaction of £8,500. Okay, so with this, we can see that our account now nicely balances on both sides. And it would then be this £8,500, which would be our receivables balance brought forward at the start of the next accounting period. Okay, so on the 1st of May. Okay, so let's crack on with our second question. I know there's some questions in the answer option, so I'll get back to those at the end of the section. So for our second topic, we are dealing with the topic of accruals and prepayments. Okay, so I selected this because it is potentially one of the harder topics in the BA3 syllabus, so a really important one to ensure that you are familiar with. Okay. So once I can get my presentation going. So accruals and prepayments as a topic essentially relate to the difference between the fact that our items, are sometimes accounted for in a different period in which they are actually used. Okay. So if we think about something like electricity, if this is maybe billed in a 3-month period every quarter, for example, this may, for example, you may utilize, say, 2 months of this electricity in the previous accounting period, but then you may actually be billed for it in the accounting period that follows this. And so we need to account for this sort of discrepancy. So an accrual essentially occurs when goods or services are received by a business but are not paid for. Okay, so our electricity example is a perfect example in this case. If we have a business that ends its accounting year on the 31st of December, it bills electricity every quarter, and it maybe has 1/3 of this electricity bill in the first accounting year, and then 2/3 of it would be settled in the second accounting year. The business is using some of the electricity in the first accounting year, and so it needs to account for the expense in relation to this in its end of year statements. But then it's obviously going to pay for this in a following accounting year. And this is where accruals come from, essentially. So an accrual is essentially a short-term liability, okay? And this makes sense because essentially what we have with an accrual is we've used goods or services. So we've used maybe electricity, for example, but we've not yet paid for it. So we owe the provider of the electricity as a result of the service that we've used, okay? So we have a short-term liability as a result. In contrast to this, we have what are known as prepayments. Now, prepayments relate to scenarios where goods or services have been paid for, but not yet actually received. Okay, so here we have short-term assets. And a really good example here would be something like an insurance payment that you'd make on your car. So for example, you would make this payment right at the start of a year, and then you would be covered insurance-wise for the 12 months that followed this. Okay, so we are paid for this good, this service at the start of this 12-month period, but are then going to receive it in the 12 months after this, okay? So we have a short-term asset, essentially, as we have amounts that we have essentially received but have not yet cashed in on. So how do we actually go about accounting for accruals and prepayments? Well, focusing firstly on accruals. Businesses account for these, so businesses account for amounts that they've used but not yet paid for by making an estimate of them when going about the accounting side of things, okay? So, for example, something like an electricity bill would be accounted for based on estimates maybe by dividing the bill over, say, a 3-month period if we are accounting for this quarterly, and this may be done based on estimates of past bills or things like meter readings, for example. Prepayments are then broken up over time. So returning to the example that we've just talked about in relation to the insurance for a prepayment example, when dealing with, say, a 12-month insurance contract, we would maybe break up this prepayment over time. So we would account for it maybe 1 month over time. So a 12th of this sort of prepayment would be built up over time every month as we use this asset. And at the end of this sort of period, there'll be 12 months worth of this prepayment accounted for as a result. Now, the key principle when dealing with accounting for accruals and prepayments, the key sort of underpinning principle here is the accounting principle of matching, okay? So the matching principle essentially centers around the fact that we need to recognize items when we actually make use of them from an accounting point of view, but that this may actually differ from when we physically pay cash out to them. So returning to our electricity example, we maybe need to account for part of our electricity bill in a first accounting year. This is when we have used the electricity bill, and so our income statement for this period needs to reflect this use of this service. However, we are paying for this in a later accounting period, and so we need to account for this accordingly. So the matching principle essentially is the key accounting principle, the fundamental principle which underpins everything about this topic, okay? Now, unfortunately, because we are dealing with quite a tight time period for this webinar, I'm going to focus on the recording for accruals. So apologies if you were looking for the prepayment side of things, but information on that is available from sort of the Astranti resources that we have on this topic. So we are going to deal with an example focusing around electricity bills for the 20X1 financial year. And in terms of the information that we have here, we can see that we have an existing accruals amount that has been brought forward from the previous accounting period. So £400 that has been used by this business in the XO financial year, but is only going to be accounted for when we actually, which is only going to be paid for when we settle this bill in the X1 financial year. We can then see that we have 4 bills in the X1 financial year. So clearly we are settling our electricity on a quarterly basis here. So at the end of the month in each relevant quarter, we have a bill to account for. And then crucially, we see that we have a bill that is carrying over to the X2 financial year. So part of this £720 worth will be accounted for in relation to its usage in the X1 financial year. Taking the previous example here, if the business seems to account for electricity on the 31st of January, then 2 months worth of this £720 amount will need to be accounted for as X1 expenses, okay? So how do we go about actually accounting for this? Well, the first thing that we need to do is bring up our accruals account. We know that we have a £400 accrual that has been brought forward from the previous accounting period. So we've used this electricity in X0, but we now need to pay for the bill as a whole in X1. Okay, so we need to adjust for this to start things off. Okay, so the way that we do this initially is we cancel out the accrual. So an accrual is obviously a liability, as we can see here. We cancel this out with a debit entry in the accruals account here. And then our double entry, if we go over to the electricity expense account here, is of course going to be a sort of credit entry in here. Okay, so our electricity account shows the expense, which is recorded by increasing the debit side of things that we need to pay in X1. We've already accounted for £400 worth of this expense in relation to this accrual from the X0 accounting year. So we will adjust our expense balance for X1 in relation to this accrual, okay? So that may sound a little bit complicated, but let's enter the other transactions that we can see on screen and we'll see how this works, okay? So our first transaction is this £525 amount from the 31st of January. Now, what this amount relates to, as a reminder, is a portion of it relates to the X1 financial year, but then we have 2 months worth of this balance to account for as part of this accrual from the previous financial year. So what essentially we have on screen at the moment is the debit for this expense. So when actually we pay this expense, we would debit the electricity expense account and we would credit our bank account. However, we are offsetting this by the £400 accrual balance that we recognized in relation to our usage of electricity in the previous financial year. Okay. We can then go ahead nice and simply and record our remaining 4 transactions or remaining 3 transactions. These all relate to the X1 financial year, so we can all just simply debit these in the month in which they are paid in our electricity expense account. And then things get a little bit more complicated when we get down to this final X2 bill, okay? So we've already established that 2/3 of this will relate to the X1 financial year, and 1/3 of this will then relate to the X2 financial year. So how do we go about accounting for this? Well, nice and simply, we need to recognize the expense that relates to our 2/3 usage of this bill in the X1 financial year, okay? So 2/3 of 720 is 480. So we would recognize £480 as an expense in this financial year, okay, to reflect our usage of this service in this period. Remember the matching principle up here. And then the corresponding double entry would be to increase our accruals account by the same amount, okay? So essentially here we are recognizing an accrual of £480, which is of course a liability. And so we are increasing this liability account by 480. And it would then be this accrual which would be brought forward as our balance brought forward at the start of the X2 financial year. Okay, so in the same way as we started this question with an accrual of £480, at the start of the X2 financial year, there would be an accrual of £480 to account for as a result of our transactions in X1. The final thing we then need to do here is to account for the income statement impact of this expenses, okay? So obviously the income statement shows all our expenses in relation to the electricity for this year. So we can total up all the debits that we've made, but then crucially, we're adjusting this balance for the 400 accrual that has been recognized in the previous year's income statement, okay? So the income statement balance is essentially the balancing figure in this double entry account of £1,690. Okay, so this would be the amount in relation to this electricity expense that we recognize in the X1 income statement. Okay. So hopefully that's provided you with a little bit of a sort of basis. And now let's flick back to our questions and let's run through a question to test the knowledge that we sort of developed on this a little bit, okay? So in this question, we are provided with a range of information about Company Q's quarterly water bill payments for the X1 and X2 financial years. And using this information, what we have to do is calculate the expense that QR would recognize in relation to these water bills in its income statement for the financial year ending the 31st of the 12th X2, okay? Sorry, I think that should say X1 down there, slight error. So essentially we are looking for the accruals, essentially we're looking for the expense to be recognized at the end of the X1 financial year. So essentially what we're going to be doing here is repeating a fairly similar process to that which we've just undergone on the Prezi presentation, okay? So we are going to need to have an accruals account on screen, and we are also going to need to have, crucially, our expense account in relation to this water bill, okay? So let me just draw those out and label them up, okay? So the first thing that we, of course, need to do here is we need to account for this accrual that has been brought forward from the previous accounting year. Okay, so we see this to be £220. Okay, so on the 1st of the 1st, the accruals account would have a brought forward balance of 220. Okay, so this is water that we have used in the previous accounting year. We've accounted for the expense in the previous accounting year, but we've not yet settled this transaction. Okay, so how did we go about cancelling this out? Well, of course, we firstly debited our accruals account with this amount. We are cancelling out this accrual. And then our double entry, of course, is a credit within the expense account, okay? So remember, we are reducing the bill, essentially, that we need to recognise in this year by the £220 accrual from the previous accounting year, okay? We can now go ahead and we can actually record the transactions relevant to the 20X1 financial year, okay? So on the 28th of February, we have a bill received of £660, okay? So our first entry, how do we go about recording this? Well, of course, we are going to need to debit our expense account. And then we are going to make a corresponding credit to the bank account. Okay, so we're recognizing the expense and we're also recognizing the decrease in our asset account as a result of this purchase. Okay, so debit expense with £660. And as we talked about earlier, we can see how this expense is sort of cancelled out by the previous accrual that we have recognized in relation to the X0 financial year. Okay, as of course, 1/3 of this bill will be recognized or will have been utilized, in the previous accounting year. And so we need to reduce the expense we recognize in X1 by this £220 mark as a result, okay? Moving on, we can then record the 3 remaining transactions that we have relating purely to the X1 financial year, okay? So on the 31st of May, again, we are going to credit our bank account with £615 and we're going to debit our expense account. On the 31st of August, again, credit bank, this time with £500, debit expense. On the 30th of November, again, credit bank, this time with £550 and debit the expense account with the same amount, okay? Now, this is where things get slightly more complicated. We can see here that we have our next bill to account for is received on the 28th of February X2, okay? So £636 worth. Now, obviously, 1 month of this relates to our X1 financial year. So how do we go about accounting for this? Well, nice and simply, we need to just account for 1/3 of this £636 figure. Okay, this is the expense that we've actually utilized in the X1 financial year, so it needs to be accounted for in our X1 income statement, despite the fact that we are going to settle this transaction in X2. Okay, so we have an accrual here. So we go ahead, and on the 31st of the 12th, we recognize a debit entry of £212 for 1/3 of this bill from the 28th of February. So we make a debit entry in our expense account, and our corresponding double entry is therefore a credit in the accruals account. Okay. So this will be our accruals balance that will be carried forward to the start of the X2 financial year. Okay, so it will adjust down our X2 expense balance there. Are we done with this question? Well, not quite, of course. What we need to do here, we need to find the expense that we would recognize in our income statement. Okay, so how do we go about doing this? Well, essentially, as we saw earlier, our income statement balance will be the balancing figure in our expense account. So we need to total up all of the expense that we've recognized in 20X1, and we need to adjust this for the £220 accrual. Okay, so the total of all our debit entries in 20X1 is £2,537. We then need to adjust this for the £220. That is an expense we've already recognized in the previous financial year. And this gives us a balancing figure, which is the amount that we would recognize as an expense on our income statement to finish things off, of £2,317. Okay, so that is the final answer to this question. Okay, so quite a complicated topic there. It's all right if you found that a little bit tricky. It is a very difficult one. But again, sort of practicing, familiarizing yourself with the theory, I'm sure it's something you'll get to grip with nicely, okay? Our final topic in this webinar focuses around non-current assets, okay? And in particular, I'm going to be focusing around the issue of depreciation in this chapter or in this section, okay? Now, the reason I picked this particular topic is it can seem quite complicated when you first start learning about it, but actually, when you get familiar with it, when you understand the processes behind this topic, it is a really good way of earning marks in the exams, okay? So if you understand the processes, I'd say there are some fairly easy marks that you can get in relation to calculations about depreciation in the exam, okay? So first things first, just to set the scene, I'm just going to go over some of the different types of assets that we deal with, just to ensure that you're familiar with these. So obviously we have tangible assets, which are physical assets that can be sort of touched. So here we're talking about like vehicles, machinery, that sort of thing. And then in contrast to this, we have intangible assets, okay? And intangible assets have no sort of physical amount to them, okay? So they still have value to a business, but something like a brand or a patent is not sort of a physical item that you can touch in the same way as a car, for example. Assets can then be current or non-current. So current assets are those which can reasonably be expected to be sold or consumed within 1 year. Non-current assets, however, can't be converted into cash. These are long-term assets and they contribute more towards business operations, okay? So it is these assets that we need to focus on in terms of depreciation, okay? So we are going to be focusing specifically on property, plant and equipment when accounting for depreciation. And the accounting standard for this, IAS 16, describes PPE as tangible assets that are held by an entity for use in the production or supply of goods or services for rental to others or for administrative purposes and are expected to be used during more than one period. Okay, so a bit of a mouthful, but essentially what we're looking at here are things like production assets. Okay. And it is these that we're going to focus on in terms of our accounting when looking at depreciation, okay? So what actually is depreciation? Well, nice and simply, depreciation is the systematic reduction of the value of tangible assets over its useful life. If you've looked into intangible assets in a little bit more detail, you'll have come across the idea of amortization, which is essentially the intangible version of depreciation. So for tangible assets, we use depreciation to reduce their value, okay? Why do we need to do this? I might hear you asking. Well, let's have a look at a quick example to reinforce this point. So let's imagine that we have a company, Company Z, and this company purchases new machinery for a value of £300,000. Now, if this company were to purely account for the expense of purchasing this new machinery in the first year of purchase, then quite clearly we can see from this diagram that it has a massive proportional impact on the company's financial position, okay? So in reality, the company has maybe actually earned a profit in this accounting year. But the fact that we recognize the full expense from the purchase of this machinery in the first year has adjusted the company's profits sort of unsubstantially, okay? So this £50,000 loss in reality shouldn't be a loss. We should have a sort of profit here. This has been disproportionately affected by recognizing this new machinery in year one in total, okay? In contrast to this, we can see in year two, we have no machinery expense to recognize. We recognize this all in year one. And so again, we have a disproportionate profit figure that's inflated by this sort of accounting adjustment, okay? So this is the issue that depreciation looks to solve. In reality, if this machine, say, had a useful life of 4 years, we would split the depreciation of this, we would account for depreciation of this asset, over this 4-year period. So we would account for a quarter of this expense in each of these accounting years. And you can see how this provides us with a much more consistent and much more accurate profit figure across this 4-year period than the extremely disproportionate loss that we registered when we recognized this asset in full in year one in our income statement, okay? So that is the reason why we depreciate assets. In terms of some other points to remember, to realize about depreciation, the depreciation charge is always shown as an expense in the profit or loss statement, as we've just seen. The depreciation charge is not allowable for taxation purposes. It's not maybe something to get too wound up in this particular syllabus. That's maybe something to take into account more for maybe F1, but just a point to remember nonetheless. And finally, it's important to remember that depreciation starts as the asset has reached the location and working condition that it requires, okay? Now, this is an important point to look out for in the context of an exam question. If, for example, you need to understand when the asset has sort of reached this location and working condition, as you need to ensure that you account for depreciation from this point in your exam answer, okay? And we'll see how this works when we get onto our question in a little bit, okay? So what are the methods that we use for depreciating assets? Well, actually, before we get into this, there are a couple of key terms for us to reinforce. The first of these, useful life, is something I've talked about a little bit already. But the useful life of an asset essentially relates to the duration that this asset will be purposeful to the business, okay? So an asset's useful economic life. Residual value is another key term that is key to understanding sort of how to depreciate assets. And this simply relates to the value of an asset at the end of its useful life. Okay, so the residual, the remaining value of an asset at the end of its useful life. Okay, so with those bits of terminology out the way, let's crack on with understanding how we measure depreciation. And actually, there are two ways in which we go about doing this, okay? So the first of these is the straight line method of depreciation. And we have a nice simple formula to remember here, okay? So we take the cost of the asset, and from this we subtract the residual value, okay? So here we're talking about the initial cost of an asset, and then we're subtracting from this the leftover value of the asset at the end of its useful life. And then we divide this total by the asset's useful life. Okay, so let's look at an example to see how this works. Let's imagine that we have an asset that is depreciated from the 1st of January 20X1. It has a cost of 13,750, i.e. this is the cost at which the asset would be initially recognized in this company's accounts. It has an estimated useful life of 10 years, and it has an estimated residual value of £500, okay? So using straight line depreciation, we would calculate depreciation per annum as follows, okay? So the cost of the asset, from which we would take our residual value of £500, and then we would divide the total of this by our denominator, which is our estimated useful life of 10 years, okay? And this calculation gives us a depreciation charge per annum of £1,325. Now, what you can see on screen that I've just brought up is the depreciation for this asset over the entirety of its useful life, okay? So we can see that every year we start with the cost of the asset, and from this we take depreciation. But crucially, it's really important to remember that depreciation actually accumulates over an asset's useful life. So in 20x1, in the first year of this asset's useful life, we would just have 1 year's depreciation charge to account for, okay? And we would subtract this from our cost to get the carrying value of this asset in our accounts. In, say, year 10, however, we would have 10 years worth of depreciation. So this accumulated depreciation would total up to be £13,250. And when we adjust the cost of our asset by this in our accounts, this leaves us with a carrying value of £500, okay? So what are these sort of accounting entries to account for this? Well, as we can see, depreciation needs to be removed from the cost of an asset every year. Now, it's really important to remember here that this is not charged to individual asset accounts, and instead we account for depreciation in an accumulated depreciation account. Okay, so here is where we build up our depreciation charge over the entirety of an asset's useful life. Okay. Now, accumulated depreciation is always credited to increase this metric. So in the first year of this example, we would have credited accumulated depreciation with £1,325. So our annual depreciation charge using the straight line method. Okay, and then we build up this account as we've seen over the asset's useful life. So in year 2, we would credit this again with a further £1,325 depreciation. And this would give us accumulated depreciation at the end of the X2 financial year of £2,650. The double entries for this are then a debit to the depreciation expense account, okay? So obviously we talked about depreciation being an expense that we recognize annually. So when accounting for our annual depreciation, we credit an expense and then we debit our expense. Of course, an expense is always increased with a debit entry, and then we credit our accumulated depreciation account, okay? So that's one of our two methods for depreciation. The second of these two methods relates to the reducing balance method, okay? Now, you may at times in exam questions have to identify the type of depreciation method to use in relation to assets. The general rule is that straight line, as we've seen, depreciates the same amount per year for assets, and therefore this reflects assets whose sort of value or the useful benefits that they generate in a sort of straight pattern over their useful life. Reducing balance, however, as the name suggests, relates to assets that maybe generate more value earlier on in their useful life and less in the later part of their useful life, okay? So we depreciate these assets a little bit differently to reflect this sort of value and when this value from these assets are generated. So, okay, we have a slightly different formula to account for here. And this time we take our carrying amount for our assets, which of course is the initial cost of this asset minus any accumulated depreciation. And then we multiply this by a depreciation rate percentage. Now, this rate percentage will always be given to you in the exam, okay? So perhaps the main way in which you can recognize the type of depreciation to apply in an exam question is whether or not you are actually given a rate percentage, okay? If you have a percentage, then of course it's the reducing balance method that you need to apply for the given question. So again, let's have a look at a little bit of an example here. Okay, so in this example, We have a company again that has a cost for their asset of £13,750, and we have a depreciation rate percentage of 13%. Okay, so applying the formula that we've just talked through to calculate our depreciation per annum using the reducing balance method, we would need to take the carrying value of this asset. In year one, we have no accumulated depreciation, so this is simply the cost of the asset, and we multiply this by our rate percentage of 31%, okay? So this would give us a year one depreciation charge of 4,200, of just over £4,000. I think we'll just stick with that, which we can see is our cost of the asset multiplied by 31%. And this would then give us a carrying value of this asset at the end of the X1 financial year of £9,487, okay? And we could then repeat this process over and over again. So in year two, our depreciation charge would be £2,941. And this is the total of our year one carrying value of £9,487 multiplied by our rate percentage. Remember, reducing balance is the carrying value of the asset multiplied by the rate percentage, okay? So in year two, what we would have to do is subtract accumulated depreciation of £4,262 from the original cost of the asset of £13,750. This gives us our carrying value, and this is the amount that we then multiply by our rate percentage to find our annual depreciation, okay? And as we talked about, the reducing balance sees a reducing depreciation charge per year in line with the way in which the asset's useful sort of benefits are generated. Okay, so we have a lower depreciation charge in year two than we do actually in year one. Okay. So how would we account for this? Well, essentially the process is exactly the same as with the straight line method, okay? So we would need to credit accumulated depreciation, which is an account that builds up our depreciation charge over time. So in year one, we would credit this with our £4,262 depreciation charge. And then in year two, we would accumulate our year two depreciation charge. Okay, so again, we would credit £2,941, and this would give us accumulated depreciation of just over £7,000 in this accounting year. Okay, and then of course, our corresponding double entry would be an expense. So we would debit our depreciation expense account with our annual depreciation, okay? So in X1, this would be the £4,262 figure. And then at the end of this year, of course, because expenses are accounted for at the end of each year, we would transfer this to our statement of profit or loss, okay? And then in the following accounting year, we would have a fresh depreciation charge this time of just under £3,000 to account for with a debit entry here. And at the end of this year, we would then transfer this as a depreciation expense to our profit or loss. Okay, so there you can just see how the carrying value of this asset will be reduced down fairly rapidly at first, actually, by our reducing balance method. Okay, and if you were to compare the carrying values of this asset maybe at the end of year two with the carrying value of the asset at the end of year two after applying straight line depreciation, you'll be able to see the differences in play here. Okay. So let's test out our knowledge for a final time using a question. So in this question, we are told that on the first of the first X3, Lou purchases some new lighting equipment for £4,000 for his photography studio. In the past, he's found that similar equipment decreases in strength over time, meaning the number of photo shoots he can successfully conduct also decreases in a corresponding manner over time. Because of this, Lou usually replaces the lighting equipment after 5 years of use. Okay, so if this lighting equipment is depreciated on a reducing balance basis at a rate of 25% per year, calculate the carrying value of Lou's asset at the end of the 31st of the 12th X5, okay? And we need to give our answer in pounds to the nearest penny. Okay, so how do we go about addressing a question like this? Well, firstly, There is obviously a distinction to be made here between whether we are dealing with straight line and reducing balance. This should always be the first step when dealing with a depreciation question. Fortunately, however, we're provided this information in the question itself, so we don't need to make any deductions here. So we know that reducing balance depreciation is calculated by multiplying the carry value of our assets by our depreciation rate percentage, okay? So first things first, let's identify these figures in our answer. So we know that the initial cost of this asset is £4,000. So this will be the starting point for our calculation. And then we know that we have a depreciation rate percentage. We've already highlighted this down here to be 25%. The other thing that we need to take into account before we actually go any further is the sort of timescale in play here, okay? So we are told that on the 1st of the 1st, X3 Lou purchases this asset, okay? So this is the date from which we need to depreciate, okay? And then we are told that we need to find the carrying value of Lou's asset at the end of the X5 financial year. Okay, so here we have 3 years of depreciation to account for, okay? So depreciation in X3, depreciation in X4, and depreciation in X5. And it is the carry value of this asset at the end of this X5 year that we need to account for, okay? So after 3 years of depreciation have been accounted for. So let's work through this process 1 year at a time to get to our carrying value at the end of year 3. Okay. So we know that the carry value at the start of the first year of this asset's useful life is £4,000. We don't have any accumulated depreciation at this point, and so our carry value simply is the initial cost of this asset. We then multiply this by our rate percentage, which we know to be 25%, and this gives us a depreciation figure of £1,000. Okay, so this is the annual depreciation that we need to charge in the X1 financial year. We're not too concerned with the double entries here, however, as we're just looking for our carry value. So we need to reduce the initial cost of this asset by this depreciation charge. And this gives us a carry value for this asset at the end of the X1 financial year, at the end, sorry, of the X3 financial year, as you can see on screen, of £3,000. So essentially what we need to do now is we need to repeat this process once for 20x2 and then again to get our answer at the end of 20x3. Okay, so we start we start second year here, so 20x4 with a carrying value of £3,000. Okay, so this is the original cost of the asset of £4,000 minus our depreciation charge of £1,000. Okay, so to calculate our depreciation for year 2, we multiply this carrying value again by our rate percentage of 25%, and this gives us a depreciation charge for this accounting year of £750. To find our carrying value, we then subtract this depreciation charge from the carrying value of the asset at the start of the year, which gives us a final carrying value of £2.25k. Okay, so £2,250. Okay, so that is the carrying value at the end of the 31st of the 12th X4. And we then need to repeat this process one final time. Okay, so the carry value of this asset at the start of the 3rd year of its useful life is £2,250. We've just calculated this. It's the original cost of the asset minus accumulated depreciation of £1,750. Multiply this by our rate percentage, and this gives us our final answer of this gives us our depreciation charge of £562.50. Okay. To calculate our final answer, we then need to adjust our carrying value for this depreciation charge. Okay. So £2,250 minus £562.50 gives us a carrying value at the end of year 3 of this asset's useful life of £1,687.50. Okay, So this is the final carrying value and our final answer to this question, okay? I think so quite clearly you can see what I was talking about at the start of this section, when you can see that actually it's quite a simple process, depreciation. It's just a case of sort of learning the ropes and then being able to apply them to a specific question. It's quite a process-driven question, okay? So once you learn the process, you should be good to go, okay? Okay, so that finishes the 3 presentations, the 3 questions that I had for this webinar. I hope you guys have all found that really useful, and hopefully it's provided you with a base about some of the key parts of BA3 that you can use and hopefully successfully tackle the exam in and of itself, okay?